And I'm Sean from CoinFlask. I provide crypto Web3 tax advisory services. Can you guys see the presentation? There we go. Move over here to that side. And we're going to talk about crypto tax and DeFi. So I want to get a little fancy, so I included the Bitcoin emblem, so I know Matt's all about that. So there we go. So what we're going to discuss briefly is the definition of crypto, how IRS classifies crypto. Hint, it's treated as property. And then, of course, what constitutes a taxable event. That's from anywhere from selling crypto for fiat, exchanging one crypto for another, using crypto to purchase goods or services, kind of like how we were talking about Sahara, or real estate and certain other transactions. Then, of course, if you're earning crypto through mining, airdrops, or staking. So to begin, the most common question I get is capital tax gains, and how do you calculate it? Fairly simple, short-term versus long-term. Short-term, you have the ordinary income rates, which range anywhere from 30 to 40%, almost half of whatever your profits are. The longer you hold it, the less you have to pay in taxes. That could range anywhere from 10, 15, 20, depending on how many years you're holding it. The other question is always, how do you calculate your gains and losses? That's typically the fair market value, which is the current price, the day of, minus how much you pay for your crypto. Quick example is if you bought one Bitcoin at 10,000 and sold it at 15,000, you made a $5,000 profit. The 5,000 is your capital gains, and that's what you're going to pay the taxes on. Income tax on crypto. So earning crypto, mining, staking, airdrops, or payments received. If you provide services, you're getting payments through crypto. That also counts as earning crypto. Tax implications. Fair market value at receipt of income is received. Most notably, the airdrops. If you have any unclaimed airdrops, no taxes there. But once you claim it and you receive that airdrop, that's when you're taxed on it. Mining example is if you mined about 0.5 Ethereum at 2,000, that was the market value of Ethereum at the time. 0.5 times 2,000 equals 1,000 income. That's what you're getting taxed on. What's the definition of DeFi? Financial ecosystem on the blockchain without any intermediaries. Who are those intermediaries? Banks, central banks. The main purpose of blockchain and DeFi is to eliminate those intermediaries, so you're not dealing with central banks. So it's not taking you 2-3 weeks to get money from one location to another. It's instantaneous. You get it done right away. Common activities in DeFi, you have lending and borrowing, yield farming, liquidity pools, and staking and governance participation. And if you participate in governance, you either get tokens for your participation. The more tokens you have, the more voting power you have, such as the case is with the Cardano Constitution. And then tax implications on DeFi activities. Lending and borrowing, any interest that is earned is considered ordinary income. Collateral liquidation could also trigger some of those tax implications. Yield farming, liquidity provision, any rewards are taxable. Tokens which are exchanged are also taxable. Staking, any rewards that you receive are considered income when you receive it. And then, of course, recent regulatory updates. We had Kirk do an amazing job in our November Crypto Mondays where he discussed this one new process that the IRS is doing for reporting requirements, whereby, for instance, if you had 20 wallets, typically you would consolidate that into one spreadsheet, net it out, and that's how you would report your taxes. This new process that they're coming out with, if you have 20 wallets, you have to make a spreadsheet for each of those individual 20 wallets, and that's what you're going to then report to the IRS on each individual wallet. Form 1099-DA for digital assets, that's something typically you might get from a central exchange. If you're going to be reporting any DeFi activities, that's going to go in your Form 8949, which is net gains and net loss from any activity. Then any global initiatives, that's going to take some time to adopt, but the OECD is a crypto asset reporting framework that's more global and global standardization, but that's going to take some time because, I mean, even at the states, national level, you report everything to the IRS, but each individual state in the United States has their own tax incentives for crypto. So, like for example, if you go down to Texas, if you're going to mine there, they're going to give you a tax incentive for that. So that's a little bit different, but having everything standardized is going to take some time. So we do have some time to kind of, swim in the gray area before everything's black and white in the future. Compliance and best practices. Always maintain a very detailed record of your transactions. That's the first thing you can do. Use tax software, but a lot of those tax softwares, they don't take into account any inter-wallet transactions. So if you have like 10, 15 wallets and you're doing transactions from one wallet to another, they're going to recognize as income going into this other wallet and you liquidating from wallet A, wallet B is getting the income. You're going to get double taxed on that. So you got to be careful with the tax software. You can use it to kind of consolidate everything, but then you have to kind of go in manually to eliminate any of those related transactions you might have. Lastly, consult any professionals that are crypto savvy tax experts. Me, Kirk. So Kirk's right there behind you guys, by the way. So feel free to reach out to either of us if you want to, if you have any questions regarding crypto tax. And then, of course, the future outlook is the regulations are always evolving. So like we mentioned, there's really no set standardization yet. There might be eventually, but that's going to take some time. Just as the blockchain is evolving, technology is evolving, you have AI, you have augmented reality, you have Web3 with games and then tokenization of social media as well. There are always going to be different guidelines coming out, and the regulators are going to try to adopt to it as fast as they can, but the time they do, something new is going to be out. So just kind of pay attention and read up on any news that comes out related to crypto taxes. Other than that, that's my contact information. I know we kind of went through this real quick, but if you have any questions that you didn't get a chance to ask today, you can always reach out to me as well.